They didn't just sell, they liquidated. Everything you've been told about market stability is a comforting lie, designed to keep you complacent until the trap shuts. What we witnessed today was not normal volatility, it was a calculated demolition. In the span of 60 minutes, $6 trillion of wealth simply evaporated. If you were watching the charts, it looked like a crime scene. Gold plummeted from 5,600 to 5,100. Silver, the more volatile sibling, collapsed from $121 down to $108. Portfolios that took months to build were incinerated in the time it takes to watch a sitcom. But while the mainstream media calls this market jitters, the data suggests something far more sinister is at play. This wasn't random bad luck. This was a mathematical inevitability triggered by a force most investors refuse to acknowledge until it's too late. To understand the violence of this crash, you have to look beyond the metals themselves. Gold and silver didn't break, they were pushed. The culprit is a mechanism known as the DXY, or the dollar index. Think of the global economy as a colossal, rusted seesaw. On one side you have the US dollar, on the other you have precious metals. They cannot both rise simultaneously. When the dollar flexes its muscles, metals get crushed into the dirt. Today, the DXY went parabolic. The dollar surged against the euro, the yen, and the pound, acting like a wrecking ball to commodity prices. While retail traders were staring at support lines on a gold chart, the real action was happening in the currency markets, rendering their technical analysis useless. You were watching the puppet, but you should have been watching the strings. 3 specific catalysts combined to create this perfect storm, forming a trio of doom for precious metals. First, the Federal Reserve. Despite the whispers of rate cuts, the Fed has remained stubbornly hawkish, signaling that interest rates and by extension, the dollar will remain higher for longer. This attracts foreign capital into the dollar, spiking its value. Second, we have the industrial slowdown in China. Silver isn't just money, it's an industrial component essential for solar panels and electronics. When Chinese factory output contracts, the demand narrative for silver collapses, causing it to bleed faster than gold. Third, political theater. With the government shutdown looming on January 31st, uncertainty forced the weak hands to fold. Profit-taking kicked in after a massive monthly rally, and the exit doors weren't big enough for everyone trying to leave at once. This brings us to the most dangerous misconception in the market, the relationship between gold and silver. They're not twins, they are distant cousins with vastly different temperaments. Silver is gold on steroids. When gold moves 5%, silver moves 10%. When gold bleeds, silver hemorrhages. Today, gold dropped 9%, but silver crashed 11%. This is the multiplier effect in action. It is the reason silver can make you rich in a month and bankrupt you in an hour. If you are leveraged, this volatility is a death sentence. The cascade of liquidations we saw, where forced selling triggers more forced selling as the market's way of punishing arrogance. Leveraged traders provided the fuel, and the institutions lit the match. However, if you zoom out, a fascinating pattern emerges from the chaos. We have seen this exact movie before, and we know how it ends. Rewind to the final days of December 2025. The setup was identical. A sharp, terrifying crash, mass panic, and a sentiment shift that screamed, the bull market is over. Yet, immediately following that bloodbath, January exploded with the biggest rally in 40 years. Gold surged 30%, silver skyrocketed 65%. The crash wasn't the end, it was the slingshot. The fundamentals haven't changed. Central banks are still hoarding gold by the ton. The supply deficit in silver is still mathematically undeniable. The only thing that changed today was the price, and for the smart money, that is not a crisis. It is a discount. So, where do we go from here? The data points to a specific horizon. By mid-February, specifically around the 15th, the dust from the political shutdowns and the immediate fear cycle should settle. If history repeats the December algorithm, we're looking at a violent reversal back to the upside. The market is currently transferring wealth from the impatient to the patient, from the emotional to the prepared. If you're holding physical metal, you haven't lost an ounce. But if you are panicked, you are about to hand your wealth over to the very institutions that engineered this flush. The red candles are ugly, but they are necessary. They clear the deck for the next leg up. The question isn't whether the market will recover. The question is whether you will still be holding your position when it does.